Hello everybody and welcome to this edition of Inside Insurance. My name is Jean Ray and I'm your host for the series and I'm a consulting partner here at KPMG. In today's session we're going to focus on tax matters, and to do that I'm delighted to be joined by Ciara Wrafter. Ciara is a partner in our tax practice in KPMG in Ireland and advises a range of clients across financial services and in particular in the insurance sector. She has over 15 years of experience and leads our insurance tax practice. She advises our clients on all aspects of domestic and international tax, including corporate tax compliance, structuring new operations in Ireland, international reorganisations and restructurings, buy and sell side transaction structuring and diligence, and the impact of legislative change. So thanks for joining me today, Ciara. And just on that topic of change, I suppose there's always a considerable amount of change in the tax world, but I suppose over the last few years it's been fairly unprecedented, I think, the amount of change there. So maybe to get us started, if you could give us a bit of a flavour in terms of some of the recent changes.
Yeah, of course. Thanks, Jean. And you're absolutely right. In the tax space, we're used to continuous change. But over the last number of years, the level of change, as you said, has been unprecedented. Some of this has been driven internationally at an OECD and EU level, and a lot of it has been domestic, right? And there's been a huge amount of consultations that have been issued by the Department of Finance, which we've participated in. Maybe if we cast our minds back nearly 10 years ago at this point, to the OECD's first base erosion and profit shifting project, or BEPS as it's commonly referred to. So as I said, this was nearly 10 years ago that project began, and there were a number of years of discussions and negotiations, and eventually a framework was agreed on, the result of which was the introduction of new legislation, pretty complex legislation across the OECD. And in Ireland, we would have introduced legislation on controlled foreign company rules, interest limitation rules, and anti-hybrid rules, to name a few. The effect of those in the insurance sector in Ireland, it's probably fair to say, has been relatively limited, which is obviously good for the insurance sector. And that just comes down to the way insurance operations are generally structured and the financing of those in Ireland. Moving on to kind of more current day changes, as part of our National Recovery Plan, we would have committed to the European Union to tackle aggressive tax planning and introduce legislation which tackled the double non-taxation of certain payments out of Ireland, right? So that would have been subject to a number of public consultations, which we would have been part of. And in last year's Finance Act, we would have introduced new rules, which are commonly referred to as the outbound payments rules. And so what do those new rules tackle, right? They tackle the payments of certain interest, dividend and royalty payments out of Ireland to certain specified territories. They tend to be territories where you have no or zero tax, right? The impact of those rules is that they disapply our domestic withholding tax exemptions. There are, of course, certain exemptions. So to the extent you make a payment of a dividend out of after-tax profits that have been previously taxed in Ireland, that should fall out of these rules. This is an important one for the insurance sector, and it's one I'm seeing coming up again and again. You know yourself, we have lots of clients that might be headquartered in sunnier climates such as Bermuda or the Cayman Islands, where there isn't, at the moment, corporate tax being levied. So those payments could potentially fall foul of those rules. So it's something that insurance companies in Ireland really need to be cognizant of, and especially because there may have been domestic exemptions in the past, and you can't automatically assume they're going to apply going forward. Moving even into more recent times again, the OECD's second BEPS project, and in particular Pillar 2, is at the forefront of everyone's mind at the moment.
And just Pillar 2, you've heard a lot about it, right? But maybe just for the benefit of those joining us today, I suppose, what's the likely impact, and I suppose who is it most relevant to as well?
Yeah, so in a nutshell, it's being referred to as the greatest corporate tax reform for a generation, right? And it's fundamentally going to change how large businesses, including insurance companies, pay and calculate their tax. As you said, who does it apply to, right? And what is it? So it applies to multinational groups who have consolidated turnover in excess of 750 million in 2 out of the last 4 years. So again, as I said, likely to catch lots of insurance groups. It's probably worth noting that when we enacted the legislation in Ireland, we extended the rules to apply to wholly domestic groups as well, albeit there is a 5-year deferral to the application of those rules. So what it effectively does is it imposes an effective tax rate of 15% on a jurisdictional basis for these in-scope groups. And the rules are currently in force at the moment. The rules are incredibly complex. I won't attempt to summarise them very quickly today or get into them. But what do they mean from a practical perspective for groups that have operations in Ireland? So I could probably summarise it into probably 4 items. The first one is there's likely to be cash tax or a top-up tax payable in Ireland, right? And that's not as simple as 2.5%. In some cases, it could even be as incremental as 15%. So it's really important that groups are thinking about Pillar 2 at all times, especially in the context of any live transactions, any intra-group payments that are being made, and any modelling that they're doing. As I mentioned before, these rules apply on a jurisdictional basis, so not something that we're used to. And what that means is that you effectively have to aggregate all entities, including branches in a jurisdiction together, and do a consolidated calculation and then effectively split out the tax back to the individual entities. What this is going to mean from a practical perspective is, you really need to understand your group. And that sounds like a really simple thing to do, but there could be other business lines in your group or investments in your group that you're not aware of or that you don't have day-to-day interaction with. And that's going to fundamentally have to change going forward. The communication and data sharing channels are going to have to be opened up to share the data across the group as a whole in a jurisdiction to be able to perform these calculations. Probably the final point is, due to the collection mechanisms that are within the Pillar 2 rules, it means that a company won't be paying tax solely based on its own profits and transactions. Other entities within the group, both in its jurisdiction, so in Ireland and outside of Ireland, can potentially impact on the top-up tax and the tax charge in their accounts that a company will have. So there's going to be internal challenges around that in terms of who are funding those liabilities and how you're going to account for those liabilities. So there's all sorts of complicated challenges that are going to arise as we move through the actual application of these rules going forward.
Just on those challenges, I suppose, given the time of year coming up towards year end, I suppose, what can and should, I suppose, groups be doing now ahead of year end, and also maybe ahead of any Pillar 2 filing deadlines as well?
Well, the good news is that the first filing deadline in Ireland isn't until June 2026. The bad news is that the rules apply from 2024, so numbers are going to be in the 2024 accounts for Pillar 2 top-up taxes. So this will need to be looked at as part of the year-end audit process. It can't be underestimated the amount of work that's going to be required from a finance and tax perspective in terms of the year-end audit, but also in terms of the filings that will be required in about 18 plus months' time. Focusing on the year-end audit, though, in the first instance, we all know in the insurance space that there are type group reporting deadlines, there's statutory filing deadlines, and they're not going to change because of the introduction of Pillar 2. So it is really all about early engagement, I think, on this topic with the audit team and the tax specialists on the audit team. There's lots that can be done this side of the year end. There can be discussions, at a high level around the group. Issues and questions can be teased out. Qualitative data can be provided by client teams, which all can be worked through. From a client perspective, there's lots of things they can be doing, to ease the burden in the new year. And, some of this, they could be looking at safe harbours to see if any of those safe harbours apply, if there are any elections worth making, and reviewing their tax losses carried forward, if they've any, to determine if it's possible to rebase those at the higher rate of 15%. So there really is lots that can be done, and I would encourage those early discussions. In terms of looking forward to filing deadlines, I suppose we don't have the form of all the returns that will be filed. But if I could give you even an indication, like the global information return, which is the kind of the big return that needs to be filed, in general, one per group, there's about 250 data points per entity on that return. So if you have 20 entities in a group, and that wouldn't be a huge group necessarily, you can see how the data points can really multiply.
So if I was to summarise at a very simple level, it feels like, I suppose, things are getting much more complex and administratively, I suppose, more burdensome. Is that a fair summary of things right now?
It is in some ways, yes, but we're definitely, I think, making strides from an Irish tax perspective to simplify our regime. Many people will have heard about the consultation in terms of our territorial system of tax, which has been ongoing for the last couple of years. And to maybe give you a bit of background for those who aren't necessarily in the tax space, we have a worldwide system of tax. So we tax worldwide income and gains, but we give double tax relief for foreign taxes suffered. That all sounds great in theory, but anyone who's been involved in it in practice will know that it's actually extremely administratively burdensome and doesn't always give you the intended result or the result you'd expect. I suppose as a result of the evolution of our tax system over the last number of years, so for example, the introduction of those CFC rules that I mentioned earlier, it had been signalled that we would introduce a participation in relation to foreign dividends. And that was confirmed by the Minister as part of his budget speech and then was included as part of the draft finance bill. And so KPMG were heavily involved in the consultation process around that. And it's been largely introduced so far as expected and will apply from 1 January 2025. So that's extremely welcomed in the context of insurance groups. And as I said, will simplify the administrative burden. In terms of whether we'll introduce a foreign branch exemption, I suppose that's less certain, and the timing around that, again, is a bit TBC. But again, would be hugely welcomed in the insurance space. There was also a consultation in 2023 in relation to the simplification of various investment products, including life assurance products. So as part of our submissions, we really would have advocated for this, both to simplify our regime in order to ensure consistency in terms of the taxation of various products. The Minister in his budget speech would have confirmed that that review is now complete, and he intends to publish the outcome of that review along with the next steps very shortly. And then I suppose finally, in terms of what we're doing or what we're hopefully doing to simplify our regime, again, the Minister announced as part of his budget speech that there would be a consultation in terms of our interest deductibility rules. Anyone who looks at interest deductibility knows there's myriad of rules. So the simplification in that space would be really welcomed.
So thanks a million, Ciara. You've covered a huge amount of ground and very complex topics. So thanks for distilling it down for us. I suppose if there was one key thing you'd like the audience to take from today, what would that be?
I think just given the time of year and the year we're in, it'd be remiss of me for it not to relate to Pillar 2. And it is to have those early conversations, not just with your audit team, to be having your conversations with your internal tax teams or group tax, with your tax advisors, and then more broadly throughout your organisation. Lots of the information you're going to need will come from legal or HR, not just the finance team. So having those conversations, making sure they're aware the questions are going to come is really, I suppose, the key message I'd like to get across today.
Okay, well, thanks a million for joining us. And thanks everybody for joining at home as well. As usual, if any of the topics today resonated with you in relation to tax, I suppose please feel free to get in touch with Ciara in the first instance, but myself or usual KPMG contact as well. Thanks for joining us, and we look forward to seeing you again soon.